Chapter 1 ESG from S book I am doing, and conceptual framework of corporate governance. So first one is meaning, corporate governance. Corporate, for these 5 words you have to remember: ACADD, 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 ACADD. So first, application, compliance, adherence, distribution, discharge. Application, compliance, adherence, distribution, discharge. Application, compliance, adherence, distribution and discharge. So for any question, if corporate governance related comes, we have to write this definition to get the more marks. Like corporate governance. So first keyword comes here: application of what? Best management practices. And next, compliance. See, for compliance of a law in a true letter and spirit. And third keyword, adherence to ethical standards. For what? Effective management. And fourth one, distribution of wealth. Not don't sit just distributing the wealth, discharge also. D, next last keyword, discharge. D, discharge of the social responsibility as well. Don't just distribute the wealth, rather you have to do distribution and discharge of social responsibility for sustainable development. Of whom? All the stakeholders who and all will come: customers, employees, government, society, suppliers. These all people will come. So application, compliance, adherence, distribution of wealth. Not only distribution, along with distribution you have to discharge as well. So distribution and discharge. Application, compliance, adherence, distribution, discharge. Application, compliance, adherence, distribution, discharge. Over this, for any corporate governance related question, you have to write according to the ICSI definition of corporate governance is as follows, and you can write this. Next, corporate governance means to steer. Steer means drive. Corporate governance means drive. And organization drive in what way? Desired direction by desired direction by determining ways. By desired direction by determining ways to take effective strategic decision. So corporate governance means driving an organization in the desired direction by determining the ways to take the effective strategic decision. It also deals with accountability. So corporate governance deals with the accountability of the individual through a mechanism which reduces the principal agent problem in the organization. Good corporate governance promotes what? Investor confidence. Why it will promote? Because it is a crucial to the ability of the entities listed on the stock exchange to compete for the capital. So there will be many other companies as well registered. If your company have a good corporate governance, it will promote the investor confidence, so that the ability of entities listed will be improved in for competing the to compete for capital raising. And next, good corporate is essential for what? To develop the additional value. First, it will promote the investor confidence, and additionally what it will do? Values to develop the additional values to the stakeholders, as it ensures transparency, which ensures a strong and balanced economic development. This also ensure that interest of all the stakeholders, that is majority or minority, both are safeguarded. So interest of all of the stakeholders are shareholders are safeguarded. It ensures that all the shareholders fully exercise their rights, and that the organization fully recognizes their rights as well. Recognition is important. So company recognizes their rights, and accordingly it will provide them the opportunity to exercise their rights. So corporate governance means 4 keywords: accountability, responsibility, fairness, transparency. And stakeholders, like who will affect because of this good corporate governance? The long-term performance of a corporate is judged. Who will judge the long-term performance of company? These stakeholders. And various stakeholders affected by the governance practices of a company include employees, customers. First, employees will get affected, and then the customers who have purchased their products, and vendors as well. because they have lent their raw materials, and government and society, government and society. And advantages of corporate governance, advantages of corporate governance. So first point, good corporate governance ensures corporate success. Good corporate governance ensures corporate success. This is a first point. Even the second point is an economic growth, that you can write a second point. Good corporate governance ensures economic growth, economic growth. And third, strong corporate governance maintains the investor confidence. Investor confidence. As a result, company can raise capital efficiently and effectively. Means with low interest, more money can they raise, and easily they can raise the funds. There is a positive impact on the share price as well. There is a positive impact on the share price. So to raise the first, corporate success, economic growth, and investor confidence, so that capital can be raised efficiently and effectively. And next, positive impact on the share price. Positive impact on share price. It provides proper inducement to the owners as well as managers to achieve objectives that are in the interest of the shareholders and organization. Means it will encourage the owners and managers to achieve what, the objectives which are in the interest of the shareholders and the organization. And good corporate governance also minimize the wastages, corruption, risk, mismanagement. So good corporate governance, when a corporate is said to be good corporate governance, when he does this all, minimizes the wastages, like before he is directly distributing the wastage and all, now he is taking some actions, then he is disposing the waste, like that, minimizing the wastages, corruption, also reducing risk and mismanagement and all. It helps in brand formation and development. Done. Next, need for corporate governance. For this, keyword is ACCEEBR. So A for accountability, and 2 C's. First, corporate performance and combating the corruption. If your corporate performance is good, then only you can combat the corruption. Corporate performance, then combating corruption. Corporate performance, then combating corruption. If your corporate performance is good and you are combating corruption, thereby enhancing the enterprise valuation, so that investor trust will increase, enhance the investor trust. And last, easy finance from the institution, and B, better access to the global markets. Not only easy finance, but we can access to the global market as well. And at last, reduce risk of corporate crisis and scandals. If these all things goes well, corporate will not do any scandals, and also reduced risk of the corporate crisis and scandals. So first, accountability, corporate performance, combating the corruption, so that enhancing the enterprise valuation. And then if valuation is good, even investor trust also will be enhanced, and when their investor trust has been enhanced, they will give easy finance. So easy finance from institution, and then better access to the global markets. And at last, if these all things are done good, reduced risk of corporate crisis and the scandals. Elements or scope of good corporate governance. Till now you have prepared very well. Means on the basis of these points you can write on your own, like elements or scope of the, or else even in CMDD also same concept is there. So from that as well you can write on your own. The question may be like three forms. First, element of a good corporate governance, or scope of a good corporate governance, or important elements of a good corporate governance. If either of these three appears, the answer remains the same. So first, role and powers of the board. Last 3 lines are okay. If these roles aren't clear, accountability suffers and company goals are at risk. If these roles are not clear, means if ID is there, he is not doing ID work, he is doing executive director work. What? All independent director work, what and all he has to perform. He is not performing, his role is not clear. So that the roles are not clear, accountability suffers, and company goals are also at risk. Good governance starts with setting up these guidelines. Next, legislation. Clear and unambiguous legislations and regulations are fundamental to effective corporate governance. So next, all board. First, board skill. To be able to undertake its functions efficiently and effectively, the board must possess the necessary blend of the quality, skills, knowledge, experience. Each of the directors should contribute to the organization's policies, operations, management. And next, board appointments, as well defined and open procedure must be in place for reappointments as well as for the appointments of new directors. Board induction and training. So now board has been appointed some person, for them induction and training should provide now. So attendance at continuing education and professional development programs is essential to ensure that the directors remain aware of all the developments, and director remain aware of all the developments and duties as well. Next, board independence. Board is essential for good sound corporate governance. This goal may be achieved by sufficient number of IDs with the board. A portion of the board members should be independent of both the management team and any commercial dealing. So they should not be related to board and commercial dealing. In between is independence director. At same time, a proper balance between ID and NED. ID and NID is also very important. And next, board meetings. Next, business and community obligation that not required. Audit committee and risk management. Committee. Evolution of corporate governance. The following theory elucidate the basis of evolution of corporate governance. So theories, anything evaluation is theory. So first, agency, shareholders, stakeholders, stewardship. Agency, shareholders, stakeholders, stewardship. Agency, shareholders, stakeholders, stewardship. First, agency theory. Think like in parliamentary sessions, before coming with any act, first committee will be there. Committee will take a detailed report, and then it will give the findings and all in a report format to the parliamentary people of Rajya Sabha and Lok Sabha. Same here also. Here the agents are the managers and principals are the owners. Agent are the managers, principals are the owners. So principal, that is owners, they don't have any knowledge or somewhat anything. They don't have the knowledge or skills, so they will assign the work to the agent, and agent will do in the good faith, and they should be faithful towards the goals of the organization, and they should report to the owners. Managers act as agent of the corporation. In agency theory, the owners are the principals. Owners are the principals. Managers are the agents. But principals may not have the knowledge or skill for getting the objectives executed. Thus, principal authorizes the managers to act as an agent. And there is so to act as an agent and principal, contract between principal and agent is made. Under the contract of agency, the agent should act in a good faith. He should protect the interest of the principal and should remain faithful to the goals. The main thrust of the agency theory is that actions of the management differ from those required by the shareholders to maximize their return. Shareholder theory. In this, shareholders will be of in high. So it is a corporation which is considered as a property of the shareholder. So company is the property of the shareholder. They can dispose of this property as they like. So the directors are responsible. Directors are responsible for any damage or harm done to their property, because director is the person who is managing the company, right? The director is responsible for any damage or harm done to their property, that is corporation. The role of the managers, means directors, is to maximize the wealth of the shareholders. They just need to maximize the wealth of the shareholders. The agent, that is directors. In the shareholder theory, the managers and the agents both are directors only. The agents, that is directors, must be faithful to the shareholders. So directors are responsible to any damage or harm happen to the corporation, and their role is to maximize the wealth, and they should remain faithful to the shareholders. And stakeholders theory. In first agency theory, they said agent, that is manager, is responsible, and in shareholder theory they are saying director is responsible. And now stakeholders theory, manager and corporation both are responsible. So according to this theory, the company is seen as an input and output model. Input output, and all the interest groups, which include creditor, employee, customer, supplier, local community, and the government, are to be considered. Think like stakeholder means who and all will come: customer, supplier, company, and all. No, supplier will give his inputs like raw materials and all. Company will give output to the customer. So input output. According to this theory, the company is seen as input model. So input and output. Input means from the suppliers. Output is what the company offers to the customers at the price. And even for shareholders also, company will offer dividend in return of their investment. All the interest groups, which and all are the interest groups: creditors, employees, customers, suppliers, local community, and the government, are to be considered. The managers and the corporation managers and corporation are responsible to mediate between these different interests. These interests different. So both managers and corporation are responsible. They have to mediate between these different stakeholders' interests. The stakeholders have adjust with each other. This theory assumes that stakeholders are capable and willing to negotiate and bargain with one another. Stakeholders are capable and willing. Capable only enough, not enough. Willing also should be. So capable and willing to what? Negotiate and bargain with one another while dealing in the normal course of business actions. Stewardship. The word steward means a person who manages another property or estate. This is like custodian or trustee, guardian. What they will do, if in case of a minor, he will take care of a minor, and he will do all things which are necessary for the primary protection, or anything to protect the minor. Same like that. Steward means a person who manages another's property or estate. Here the word is used in the sense that guardian in relation to corporation. So guardian in relation to company. Even debenture trustee is a guardian for the debenture holders. The managers and employees are to safeguard the resources of a corporation and its property. In the three theory, we have not read about safeguarding resources and property and interest. So here in this theory, safeguarding the resources of the corporation and its property and interest. When the owner is absent, normally owner will take care of this all, but when the owner is absent, guardian has to take care of safeguarding the resources of the corporation, property and interest. Even think like guardian of a minor also does these things only now. They are like caretaker. They have to take utmost care of the corporation. Done. And in page 1.9 there is a OECD. That is enough. Like in that, a set of corporate governance standards and guidelines. In order to fulfill this objective, the OECD established the ad hoc task force on the corporate. So the principles, that is chapters. The chapters developed here as the chapters are: first, right of the shareholder. Everything is shareholder, stakeholders, transparency, responsibility. That's all. First they will speak about shareholder and stakeholder. Share, stake. And next, disclosure and transparency as per the SEBI allowed here, and responsibilities of the board. Right of the shareholders, equitable treatment of the shareholders, role of the stakeholders, disclosure and transparency, and responsibility of board. So first, RER, DR, R for rights, E for equitable treatment, R for role, D for disclosure and transparency, and last R is for responsibility of the board. So they have covered everything. First, shareholder. Why only shareholder? Stakeholder also covered. And next, disclosure and transparency, and at last, board responsibility. And next, A4S, that is accountability for sustainability. This was established with the aim to make sustainable business decision making business as usual. It lays down the foundation for development of other initiatives such as IIRC. A4S aims to inspire action by finance leader to drive a fundamental shift towards resilient business models and a sustainable economy. To do this, A4S has three core aims. A4S is 4 minus 1 is 3. So 3, 3, 3, 3. A you assume as 1. So 4 minus 1 is 3, 3, 3, 3. So 3 core M's, 3 core M's, and A4 is 4. 4 is in. So in 2004 this has been came. 2004 this has been came, and A minus 4, that is 3. So 3 core M's, 3 core M's. First, to adopt sustainable and resilient business model. To adopt, the word itself, accountability for sustainable. So first point is sustainable. For what? To adopt sustainable and resilient business models. And next, transform financial decision making to enable an integrated approach. So first keyword is sustainable, second keyword is integrated approach reflective of the opportunities and risk posed by environmental and social issues. Next, scale up actions across the global finance and accounting community. So first, adopt the sustainable and integrated approach we have to use. And after once we have sustainable and integrated, our actions will be scale up across the global finance and accounting community. Kyoto Protocol. It only binds developed countries. Places a burden on them under the principle of common but differentiated responsibility and respective capability. Common but differentiated responsibility. When compared to a developing country, this is developed now, so differentiated responsibility will be and respective capability, because it recognizes that they are largely responsible for the current high levels of greenhouse gas emission in the atmosphere. However, the protocol also offers them an additional means to meet their targets by way of 3 market-based mechanisms: international emission trading, clean development mechanism, joint implementation. So first is clean development mechanism. Clean. Greenhouse gas they are doing, so they are responsible. So they have differentiated responsibility. So first to develop the clean development mechanism. Jointly they can do joint implementation. So that international emission trading. Next, ISO 26000 standard is intended to assist. The name ISO, I is a 1, O is a 0, like that thing, and they have came in 2010. ISO 2010. I is 1 and O is 0, so 2010. So 2010. Assist the organization in contributing to sustainable development. So ISO 26000 provides guidance to all types of organizations regardless of their size or location. So ISO 26000 provides guidance to all the types of organization regardless of their organization size or the organization location. So first, concept and definitions. Like think like a chapter, how it will start. First, concepts and definitions, and then background, trend, characteristics of the social responsibility. So chapter is about social responsibility. So first they will give the concept and definitions related to social responsibility, and next in the chapter what they will give backgrounds and history and all, and the trends, how it has evolved, and the characteristics, and then principles and practices related to social responsibility, and next the core subjects and the issues of the social responsibility, and then last, integrating and implementing the social responsible behavior throughout the organization, and identifying and engaging with the stakeholders, communicating commitments, performance, and other information related to social responsibility. So it starts like a chapter. First, concept and definition, and the next background and trends and characteristics, and next the principles and practices, and core subjects and issues related, and integrating the implementing and promoting, means more people have to come and do the social responsibility, etc., and identifying, engaging with the stakeholders, not only company along with that engage the stakeholders as well, and at last what and all social responsibility we have did that we have to communicate the commitments and performance. This much we have committed and this much we have performed according to our commitments, and other information related to social responsibility done. So ISO came in 2010. It says about social responsibility as a chapter. What and all we can go through in any chapter. This chapter is related to social responsibility. So as a chapter we can write. So this chapter will provide guidance to all the types of organization regardless of their size or location. Next, integrated reporting in 2013, integrated reporting framework published by International Integrated Reporting Committee has so integrated reporting framework. So IIR framework published by IIR committee has a framework that provides what? A tool for all the companies. So even ISO and integrated, it provides for all the types of companies and all companies to report on their efforts, to embed the ESG and non-financial management into core business. Like my business is into financial, how I am embedding ESG and non-financial management. Normally my core business is not into this ESG and non-financial matters things. How I am taking efforts to embed the ESG and non-financial regarding that report has to frame, and that to give the report, this framework gives the tool, and the report on ESG and financial performance together in a single streamlined report. So these reports contains everything like first financial and non-financial and ESG related in a single streamlined report. Governance from Indian scriptures. The Arthashastra by Kautilya can be regarded as one of the first and significant source in the development of principles of national as well as corporate governance in India. Principles of Ramayana. First, governance has no inequality. Governance has no differences between rich and poor. Governance has no inequality and no differences between rich and the poor. The structure of governance should be such that the environment of mutual trust and love is promoted, and this means that there is no jealousy or no malice amongst the subjects. Governance should promote the commitment to duty, and doing the duty properly gives ultimate happiness. Governance system should promote education of one and all. Governance should promote the good health. So last 3 points is promote duty, promote education, promote good health. Promote duty, promote education, promote good health. And first one was no inequality, no difference between rich and poor, and second is environment of mutual trust and the love. Shanti Parva meaning the book of peace. Shanti Parva, peace. It is believed to be set of instructions given by the Sri Bhishma, eldest among the Kuru family, called Pitamaha. So this is given by the Pitamaha, instructions given by to King Yudhishthira. This book is divided into 3 sub-parvas. Parvas means parts. Rajadharma, Apadharma, Mokshadharma. Rajadharma, Apadharma, Mokshadharma. Rajadharma means duties of a king and his governance. Apadharma means rules of conduct when one faces adversity, and Mokshadharma, behavior and rules to achieve the moksha. Bhagavad Gita. The emphasis of Bhagavad Gita is dharma. Dharma means the rightness, accountability of self, family, organization and society. So the rightness and accountability of 4. First self, then family, then organization, then society and the progress as well. So accountability of 5. Self, family, organization, society. Self, family, organization, society for orders and progress. Some of the important aspects of governance touched upon the epic. In the epic of Mahabharata, based on above ethical principles. Public interest should be given priority over private or personal interest. So prefer the public interest. Uphold dharma regardless of the conflict of interest. If any conflict of interest, uphold the dharma which is the unique to that person. Transparency should be maintained in demonstrating the path of the dharma. Transparency. So first, prefer the public interest, uphold the dharma in case of conflict of interest, and transparency should be maintained. And next, then Arthashastra. Important aspects of governance framework to which the king should give attention are briefly discussed below. So focusing on king. King is a servant of the state. Yes, king is a servant of the state. Leaders should be responsive. accountable and removable. Leaders should be responsible, responsive, accountable and removable. Strict ethical guidelines and code of conduct. Strict ethical guideline and code of conduct. Strict ethical guidelines and code of conduct. Emphasis of stakeholder concept. Emphasis of stakeholder concept. Effective administration. Effective administration. Effective administration. So KLS KLS. First one is servant. Accountable, responsive and removable. King is a servant. Leaders should be responsive, accountable, removable, responsive. Strict ethical guideline and code of conduct. Emphasis of stakeholder concept. Effective administration. Theory of business ethic. 2 is there. Teleological, deontological, teleological, deontological. Further, in teleological, there are 2 doctrines. There is a doctrine of utilitarianism, utilit, REARI, anism, ANISM, utility, UTILITARIANNISM. Text. The principle of utility. By the principle of utility is meant that the principle which approves or disapproves of every action whatsoever according to the tendency which it appears to have, argument or diminish the happiness of the party whose interest is in question, or what is the same thing, in other words, to promote or to oppose that happiness, to promote or oppose that happiness. Thus the consequence of an action are measured in terms of the pleasure and the pain caused to different individuals. Principle of utilitarianism. Thus, there are 2 forms of this. First, action and then rule. Action, rule. Action utilitarianism, under which an action is right if and only if it produces the greatest balance of pleasure over the pain for everyone. Rule utilitarianism, under which an action is right if only if it conforms to general accepted rules and produces the great balance of pleasure and over pain. So in action only balance is okay, but in rule, according to rule, and balance between pleasure and over the pain should be there. Principles. Consequentialism. The principle of utilitarian consists of following elements. So consequentialism, hedonism, maximization, universalism. So first, consequentialism. The tightness of any action depends solely on its consequence. Hedonism, pleasure alone is good. Maximization, a right action is one that creates greatest among net pleasure. Everyone's consequences are alike. So, CHMU. First, consequence. Next, hedonism, that is pleasure alone is the good, and maximization and universalism. Deontological is derived from the Greek word deon, which means duty or obligation. Duty or obligation is a fundamental concept in this theory. According to theory, certain actions are right, not to some benefit to self or others, but due to their basic nature or rules underlying them. A bribery by its very nature is wrong, irrespective of its consequences. So this is certain actions are right, so not accepting the bribery is right, not due to some benefit to self or others, but due to their basic nature or rules underlying them. And W.D. Ross, British philosopher, has given the following moral rules with respect to deontological. So all the words starting from duties of fidelity, reparation, gratitude, justice, beneficence, self-improvement, and non-maleficence. Actions are right or wrong not because of their consequence but because of our duty or obligation. So there are 7 duties. First, fidelity, FIDE, fight, LITY, fidelity, reparation, gratitude, justice, beneficence, self-improvement, non-maleficence. First one is to keep the promises both explicit and implicit and to tell the truth. In reparation, to compensate people for injury that we have wrongfully inflicted. To compensate people for injury, to compensate the people for injury that we have wrongfully inflicted. To return favors that others do for us. To ensure that the goods are distributed according to people's merits. To do whatever we can improve the condition of others. Self-improvement, to improve our own condition with respect to virtue and intelligence. Non-maleficence, to avoid injury to other. Concept of management versus ownership. Shareholders own the company. Shareholder owns the company. Hence, the company ought to work according to the dictate of the shareholders. So, shareholders are the owner. According to their dictation only should work the company. However, it is not practically possible for each shareholder to participate in the decision making on a day-to-day basis. Further, shareholders generally cannot know and manage the full details of the business, nor do many wish to. They elect a board of directors to make a broad corporate policy. So they elect a board of directors to make broad corporate policy. Companies allow for the separation of ownership and management. Companies allow for the separation of ownership and the management. That means the owners don't need to be managers and managers don't need to be owners. In most small corporations, the owners typically manage the company, but it is not necessary that owners run the company or even involved in the day-to-day operations of the company. The concept of majority rule versus minority interest. A company is an artificial person with no human existence. It functions through the instrumentality of board of directors who is guided by the wishes of majority, subject of course to the welfare of the company as a whole. It is therefore a cardinal rule of the company law that prima facie a majority of the members of the company are entitled to exercise the powers of a company and generally to control its affairs. So, in the case of Force versus Horbital, F versus HARBOTTLE, Horbital, wherein it was held that the courts would not generally interfere with the decisions of the company, which it is empowered to take insofar as they had been approved of by the majority and made exceptions to breach the character documents, fiduciary duties and fraud or oppression and inadequate notice to the shareholder. So, normally court will not involve into the decision taken by the board, but if they do any breach to the charter documents, fiduciary duties breakage and any fraud and or oppression and mismanagement and inadequate notice, in that cases court will involve. Roots of corporate governance in India. There is a great deal of similarity in the governance structures of the ancient kingdoms and the modern corporation, as is evident from our ancient text and the scriptures. First, Ramayana. The Ramayana, the sage of a Rama's life, written by the Valmiki, is widely acclaimed as amongst the greatest of all the Indian epics. In fact, the famous Grantha carries useful tips. So, it carries useful tips on ethics and values, useful tips on ethics and values, statecraft and policies, ethics and values, statecraft and politics, and even general and human resource management, So first, useful tips to ethics and values, statecraft, politics, and even general and human resource management. Bhagavad Gita. Lord Krishna details the divine treasure as fearlessness, purity of the heart, fearlessness, purity of heart, knowledge, charity, self-control, sacrifice, knowledge, charity, self-control, sacrifice, study of the scriptures, uprightness. The Bhagavad Gita emphasized the concept of duty and its importance for the good leadership. Mahabharata, Shanti Parva, which is the part of Indian epic Mahabharata, recites the duties of the ruler, dharma and a good governance as counseled by the dying Bhishma Yudhishthira. A prosperous kingdom must be guided by the trust and the justice. The duty of a ruler and his cabinet is to enable people to be happy, pursue truth and act sincerely. Kautilya, fourfold duty of a king. Raksha, Vriddhi, Palana, Yogakshema. 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 Corporate governance contemporary developments in India. First, 1998 desirable corporate governance accord. Desirable. The objective was to develop and promote a code. Design and objective was to develop and promote a code for corporate governance to be adopted and followed by the Indian companies, whether private or public or banks or financial institutions, or all of which are corporate entities. In April 1998, the code was released. It was called Desirable Corporate Governance Accord. And 1999 Kumar Mangalam Birla Committee to promote and raise standard of corporate governance. To promote and raise the standard. First was develop and promote. Now promote and raise the standards. Promote and raise the standards of corporate governance. The recommendation of the report led to inclusion of clause 49 in the listing agreement in the 2000. Now we will read clause 49 of SEBI LODR regulations that was added in the year 1999, that too because of Kumar Mangalam Birla Committee. Clause 49. 2002 Naresh Chandra Committee. Enron debacle of 2001 involving the hand-in-glove relationship between the auditor and corporate client. Auditor and corporate client means auditor and client. Led the scams involving the fall of corporate chains in US like WorldCom and all. Led the Indian government to wake up. And in the year 2002, Naresh Chandra Committee was appointed. Naresh Chandra Committee was appointed in the 2002 and to recommend inter alia amendments, to examine and recommend the amendments to the law involving the auditor-client relationship. So Naresh Chandra Committee, you have to examine and recommend the amendments that in relation to auditor and client relationship and the role of ID, auditor client and ID related. SEBI therefore constituted a committee under the chairmanship of Sri N.R. Narayana Murthy for reviewing implementation of the corporate governance code by listed companies and for issue of revised clause 49 based on its recommendations. And 2004 Justice Iradi Committee also recommended the constitution of Stakeholders Relationship Committee and provisions of duties of directors in the act with the civil consequences for non-performance. So constitution of Stakeholders Committee and provision of duties of directors, provision of duties of directors with the civil consequences. 2009 Corporate Governance Voluntary Guidelines. Businesses will help India meet its goal. To meet its goal of inclusive and sustainable all-round development. It urged businesses to embrace the triple bottom line. That is people, planet, profit approach, whereby their financial performance could be harmonized with the expectations of the society. So Financial performance could be harmonized. Financial performance could be harmonized. Financial performance could be harmonized with the expectations of the society, environment, and mainly stakeholders. So, people, planet, profit. People is society, profit is an society, planet, and environment is a planet, and stakeholders for profit and all in a sustainable manner. And Companies Act brought it with radical changes in the sphere of corporate governance in India. 2015 SEBI LODR regulations in a view to consolidate and streamline listing agreements for different segment of the capital market and provisions pertaining to listed entities. Next, 2017 Uday Khota Committee, objective recommend adopt. So first objective was like aim of improving standards of corporate governance of Indian listed company, ensuring the independence. So they have recommendation to SEBI on the following issues: ensure independence in the spirit of independent IDs. So there are IDs, but where is their independence? That has to be ensured, and their active participation in the functioning of the company, improving safeguards and disclosures pertaining to RPT related party transactions. So first ID, then RPT, and then issues in accounting and auditing practices by listed companies, improving the effectiveness of a board evaluation process, board evaluation process, addressing issues faced by investors and on voting and on participation, disclosures and transparency related issues. The committee submitted its report, and that report contains the first recommendations like composition and role of the board of directors, how much should be the composition and what is the role of each board and board of the directors, the institution of IDs, board committees like audit committee, NRC, RMC, like enhanced monitoring of group companies, promoters or controlling shareholders, and RPT, promoters, controlling shareholders, RPT, and RPT, disclosures and transparency, accounting and audited related issues. So objective was objective of the meeting in first, and according to that what and all they gave the recommendation, and next out of the recommendation which are the accepted is like increasing the transparency, enhanced disclosure requirements, disclosure of utilization of funds from the QIB or pref issue, and disclosures of auditor credentials, audit fee, reason for resignations, disclosures of skills of directors, enhanced disclosures of RPT, separation of office of the chairman, that is CEO or MD, enhanced quorum, capping the maximum number of directorships, that is 20, secretarial audit to be mandated for listed entities and their material unlisted subsidiaries, that is section 204. 2019 National Guidelines on, that is NGRBC. This question may come either in CMEDD or ESG or drafting. The guidelines on integrity, next 2020 guidelines on integrity and transparency in the governance and responsible code of conduct, the CII code 2020. So as under first, integrity, ethics, responsible governance, citizenship, role. See, in the code itself what they gave: integrity, transparency, governance and responsible code of conduct. That only we have to write. So integrity, ethics, governance and citizenship, role of high performing board, balance the interest of the stakeholders, ID and WD, risk management, succession planning, investors activism, visa mechanism, and etc. 2020 report of committee on BRR, report of committee on BRR, NVG, that is National Voluntary Guidelines, were updated. It was decided that SEBI BRR framework should also be revised. So by seeing others getting updated, even we also want to get updated. So to revise the effect changes made in the base document, the Secretary Corporate Affairs constituted a committee under the chairmanship of Joint Secretary MCA to prepare the BRR formats for both listed and unlisted. The formats were developed to serve as a single comprehensive source of non-financial sustainability information relevant to all the stakeholders, that is investors, shareholders, regulators, public at large. The formats were developed to be simple and mindful of the cost and the burden. The information sought in the formats is a mix of quantitative and qualitative. The formats were developed for all the companies, listed and unlisted, and the formats were developed with a view to filled electronically and integrated with the MCA 21 database. Development of corporate governance in UK. So Cadbury report. The committee submitted its report in 1992 and developed a set of principles of good corporate governance which were incorporated into London Stock Exchange listing rules. Principles of comply or explain. Principles of comply or explain. Either comply or explain. It made the following three basic recommendations. CEO and chairman of company should be separated. Board should have at least 3 NEDs, 2 of whom should have no financial or personal tie-ups to the executives. Each board should have an audit committee composed of NED. So 3 recommendations. Basic. Greenberry committee. Green means money, remuneration, that related. A group under chairmanship so and so recommendations on the directors remuneration. Directors remuneration was constituted. Constitution of remuneration committee comprising of NED. So there should be a committee for constitution of a committee comprising of NEDs for the remuneration committee. Constitution of a remuneration committee. The committee's work is only to deal with the remuneration and all matters. Responsibility of this committee is determining the remuneration. Determine the remuneration of whom? CEO and ED. Remuneration responsibility of the committee is determining the remuneration policy as well. So first, remuneration committee has to be constituted of NEDs and committee of NEDs, and they will determine the remuneration for CEO and ED, and through the policy they will determine, and disclosures to the shareholders, level of disclosures, and remuneration should be linked more explicitly to the performance. So everything related to remuneration in 1995 only they have decided what to do and all. 1995 Greenberry report. 2003 Higgs report. HIIG. The role of ID and audit committee. The resulting report proposed that at least half of a board be comprised of the NED, half of the board NED, excluding the chair. Remaining directors half should be NED. That the NED should meet at least once a year in isolation to discuss the company's performance. That a senior ID be nominated and made available for shareholders to express any concerns. That the potential NED should satisfy themselves they possess the knowledge, experience, skills and time to carry out their duties with due diligence. Next, corporate governance code in the major jurisdiction across the world. So first, Sarbanes-Oxley Act. Sarbanes-Oxley. So SOX section 302. SOX section 302, corporate responsibility for financial reports. So first, this all speaking about CEO and CFO only majorly. CEO and CFO must review all financial reports. So they have to review all the financial reports, and the financial report does not contain any misrepresentation. That also they have to ensure information in the financial report is fairly presented. So 3 points is financial reports. CEO and CFO, but may still most specifically they are related to financial reports. CEO and CFO are responsible for the internal accounting controls. If any report any deficiency in the internal accounting controls, and or any fraud involving the management of audit committee. If any fraud involving the management of audit committee, that also has to be reported, and indicate any material changes in the internal accounting controls. So 2 things, first financial and internal accounting controls, and one more, if any fraud is there, that also has to be reported. Fraud involving the management of audit committee. Next, section 4 note 1, all the financial statements that and their requirements to be accurate and presented in a manner that does not contain the incorrect statements. And 409, companies are required to disclose on all almost real-time basis info concerning material changes in the financial condition. So section 302 talks about three things. First, financial reports, internal accounting controls, and if any fraud involved with the management of audit committee. And 401, like financial statement should be accurate and presented in a does not contain the incorrect statements, accurate and presented in a manner that does not contain the incorrect. And 409, on real time basis should be disclosed. And 806, whistleblower protection should be there. This section deals with the whistleblower. And 906 section 906 addresses the criminal penalties for certifying a mislead or fraudulent financial report. Next, section 303A, corporate governance standards. NYSE, companies listed on the exchange must comply with the certain standards regarding corporate governance as notified by the section 303. Equity listing, it applies in full to all companies listing common equity securities. Close-ended and open-ended. UK Corporate Governance Code 2008. And UK is same as like India only. Remember heading and you can write the matter own. Board leadership and company purpose. So first, board is formed and values and establishments and objectives and all. Division of responsibilities. Chair leads the board and responsible for overall, and board should appropriate combination of ED and NED. Board should have there should be clear division of responsibilities between the leadership of the board and the management board. The board supported should be by CS. And next, composition, succession, evaluation, and audit risk and internal control, audit risk, internal control, remuneration. Next, corporate governance principles and recommendations of the Australia. So 8 central principles. So this goes on the fundamental approach that if not, why not? And 8 central principles are: first, lay solid foundations for the management and oversight. Lay solid foundation should be solid for the management and oversight. A listed entity should clearly respective roles and responsibilities of its board and management are regularly review their performance. Next, structure the board to effective and add values. First, do the foundation, then go for any structuring the board to be effective and add value. First foundation, then structure. Foundation, structure. Once foundation ready, structure ready, then install a culture of acting lawfully, ethically, responsibly. Install a culture. Next, safeguard the integrity of the corporate reports. Now foundation ready, structure ready, and culture lawfully, ethical and responsibility. This culture is also installed. Whether actually lawfully, ethical, responsibility culture is there or no, that has to be reported now. So safeguard the integrity of corporate reports. Next, safeguard the integrity of the corporate reports. Make timely and balanced disclosure. Respect the rights of the security holders. After all this done, the security holders will come. Respect the rights of the security holders and recognize and manage risk. Remunerate fairly and responsibly. So foundation structure, culture of 3 things: lawfully, ethically, responsibly, and then safeguard the integrity of the corporate reports and make timely and balanced disclosure, respect the rights of the security holders, and then recognize and manage the risk and remunerate fairly and responsibly. And in yellow box they gave like ID's tenure. ID will have the tenure of 9 years, where ID has served consecutive 9 years. Continuation on the basis of continuation will be subject to two-tier voting system, and the board must majorly independent, where the board chair is not independent, and code establishes regardless of board chair, NED director will be need to comprise the board. Next, King 4 principles. The board will be replaced with the governing body. Board instead of board, write the word governing body. Rest same like UK only. First, leadership, ethics, corporate governance. So board should GB, governing body should lead ethically and effectively, support ethical culture, responsible corporate citizen and strategy and formulation. Governing body's core objective, purpose, risk and opportunities. Governing body should ensure the reports issued by enable to informed assessment and governing structures. That governing body, it is a board responsible to take care of the organization. And evaluation of own, committee, chair and individual and members. So evaluation of own committee and chair and individual and members. Next, governance functional areas. In that 11, 13, 14 are enough. And next, stakeholders relationship. In that the stakeholders theory, whatever we have read in stakeholder theory, that only will come. And related to A4S accountability for sustainability, that only 17th point. Next, OECD principles of corporate governance. This you will read in the chapter 3, so no need to read here. And OECD principles are same like Indian company. Principles provide guidance through recommendations and annotations across 6 chapters. So in this 2, 3, 4, 5 is important. 2, 3, 4, 5, 2, 3, 4, 5, 2, 3, 4, 5. The ensuring the basis for an effective corporate governance framework. First, framework should be there, then rights and equitable treatment for shareholders and key functions. This is SEBI allodial topic only, second point. This includes basic shareholders right, include to dividend participation in the meetings and vote, appointment of the directors, right to informed about the decisions and all, convey or transfer rights, obtain relevant and material info. Shareholders should have opportunity to participate effectively and vote in the general shareholders meeting, and agenda, date, venue, time and how to vote, process and opportunity and all should be given. And shareholders include QIB and mutual fund units also should be allowed to consult with each other, and all shareholders should have the same series of the classes should be treated equally. Next, third also important, institutional investors, stock markets and other intermediaries. Institutional investors, stock markets and other intermediaries. I acting in a fiduciary capacity, so they are acting in a fiducial capacity. Votes should be cast by the custodian or nominee in line with the directions of the, like I am the creditor, I have made a proxy, so proxy should vote according to my instruction. Same, vote should be casted by custodian or nominees in line with the directions of the beneficial owner. I acting in a fiduciary capacity should disclose how they manage material conflict of interest, and corporate governance framework should provide the proxy advisories, analysts, brokers, rating agencies, disclose and minimize the conflict of interest. Insider trading and market manipulation should be prohibited. And sixth also we can write in our own, for companies which are listed in multiple countries have to disclose the applicable corporate governance laws and practices which they are complying with. And seventh, stock market should provide for fair and efficient price discovery. Role of stakeholders in the corporate governance. The rights of the stakeholders, they are established either through law or agreement. Are to be respected. Where stakeholders' interests are protected by law, should have the opportunity to obtain the effective redress for violation of their rights. And access, where stakeholders participate in the corporate governance process, they should have the access to relevant, sufficient, reliable info on the timely and regular basis. And illegal, stakeholders including individual employees should be able to freely communicate their concerns about illegal or unethical practices like a whistleblower. And disclosures and transparency related to the material information on the financial, non-financial, remuneration, RPT, and annual audits and auditing standards, financial, non-financial information. Auditor is accountable to disseminate the information. And then last, responsibilities of the board. The board members should act in a good faith in the best interest of the company and the shareholders. The board should treat all of them fairly. It should take account the interest of the stakeholders. Board members should have access to accurate, the relevant and timely info. Done. Fifth, not required. Finish corporate governance code. If this question comes like anything related to remuneration comes policy and nomination remuneration committee. Policy and remuneration policy and nomination remuneration committee works will be that only we have to write. So first, purpose of the corporate governance code is to harmonize the procedure of listed companies to promote corporate governance and remuneration. Fifth, the company's remuneration statement has been placed by the remuneration policy for governing bodies, that is remuneration policy is in place. Remuneration policy and report concern the company's board of the director, supervisor board, and if any, and the managing director and deputy managing director. Simply, the board must in future, which of the board members are independent of the company, which are independent of the company's significant shareholders. In addition, the reasoning of determining that board member is not dependent must all means on the what basis you are saying this person is dependent, this person is independent, like that and all should say. So in brief, like a remuneration statement to remuneration policy should be there, and disclosure related to remuneration of director, board of directors, MD and DMD also should be there in board report who is ID and reason why member is not independent. And Italian corporate governance code applies to all the companies with the shares listed. Adoption of a code is voluntary, and 6 articles, and each articles of the code is divided into principles. There are two types of the board: 1 tier, 2 tier, 1 tier, 2 tier, 1 tier, 2 tier. 6 companies apply the code according to principles of substance over form, and recommendation thereof on comply or explain. And 7th, companies adopting the code provide in their corporate governance report accurately, easily understandable, exhaustive, concise information on how code is applied. The application of a code implies, however, that each deviation is clearly indicated in the corporate governance report, and that companies explain how the best practices recommended by code has been disregarded, describe the reasons for any deviations, describe how the decisions to depart from the recommendation has been made within the company. If the deviation is limited to in time, indicate when they plan to apply. And 5th, not required. Japan Stewardship Code. Japanese Stewardship Code, Principles for the Responsible Institutional Investors. Corporate Governance Code applies to all the institutional investors, and it recommends the stewardship activities of I should involve, and it focuses on the client returns in the medium to long term, and engages with the investee company for sustainable growth, and engage with the investee company for the sustainable growth. This in turn improves the economic growth, and institutional investors, asset owner, that is AO, and asset manager, that is AM. So AO will make the policy regarding what they expect from the company. We will make the policy regarding what they expect from the company, and asset manager will take part in that in day-to-day activities of the company. So asset managers assesses the needs of the asset owner, and asset owner should not demand short-term returns, and asset owner should make recommendations which are in line with the code. And intermediaries, which includes proxy advisory firm, should act responsibly and discharge the functions as prescribed under the code. Next, global corporate governance forms. In that third one, the Institute of Directors, UK. Non-party political business, that is private organization established in UK. The objectives of IOD is to promote for the public benefit high levels of the skill, knowledge, professional competence, etc. That is skill upgradation, to promote for the skill upgradation, and to promote the steady research develop of the law, practice, corporate governance, and that is study and research related to promote, and to represent the forum. And next, to advance the third one is to forum, disseminate the information to the business community, and fourth is to advance the interest of the members of the institute, and to provide facilities, services, and benefits to them. And then international corporate governance network. Non-profit organization, that is NPO and guarantee company not having share capital. So NPO, guarantee company not having share capital, NPO, guarantee company not having share capital. These companies are governed by MOA and AOA, and control is with the board of governor. So governor will make up policies, and that will be implemented across the International Corporate Governance Network, that is ICGN from India, and from India ICS is also member of this ICGN. So ICGN mission is to promote the effective corporate governance, and investor stewardship. Investors stewardship means investors guardians. Investor will invest the money enough, for that guardian should be there. So investor stewardship and sustainable economy. So first they are looking after the effective corporate governance, so that company will working good, and then investors will be secured through the stewardship, and then sustainable economy, all the company and stakeholders and economy, all the three will be should be good. That is a measure of ICGN, and they do this by influencing the policies by the investor opinion. So on the investor opinion, like what and all they are facing, any issues and all, on their point of view they will make the policies, and connect the peers at the international forum, and educating about the good corporate governance. Primary purpose to form the forum. Investors can exchange views as to corporate governance issues. Examine the practices and principles of corporate governance, and develop and encourage the adherence to corporate governance standards. The European Corporate Governance Institute, so ECGI was founded in the 2002. It is an NPO to improve the corporate governance through fostering independent scientific research and related activities. So scientific research and related activities. So third point, primary role is to undertake and commission and disseminate research on corporate governance. And vision statement. First, it sits at the center of the success and failure of our economic systems, and as it such warrants knowledge, research and insights of the best thinkers, practitioners and policy makers of our age. That is precisely what ECGI seeks to provide. It draws on the finest minds in academia from all over the world to tackle some of the most important issues that confront businesses and governments today. It uses the power of research to change ideas, influence the practice and formulate a policy to benefit all of us. And mission statement. Vision first point is like corporate governance is believed to be that center of the success and failure of the economic system, and the vision is to enhance the same. Before we read ICGN, International Corporate Governance Network, that focuses on the investors, shareholders. This ECGI will deals with the both corporate with all stakeholders and in a scientific matter related. So both it will deal shareholders and scientific matter related. Mission statement of ECGI. The mission of ECGI is to assist the top academies in the field of corporate governance in the bringing their research to the attention of leading practitioners, policymakers. Conference board. It is a body structured in the form of NPO. This conference board creates and disseminates the knowledge about management and the marketplace. Mission: equipping the world's leading corporations with the practical knowledge they need to improve their performance, better serve society, and to help our members understand and deal with the most crucial issues of our time. And fifth, the conference board may governance programs help companies improve their processes, inspire public confidence and ensure they are complying with the regulations. And 8th point, the conference board global corporate governance research center brings together a distinguished group of senior corporates executives from leading world class companies and influential institutional investors in a non-binding setting. Next, Asian Corporate Governance Association. This is also in the form of NPO. Dedicating to working with the investors, companies and regulators in the implementation of effective corporate governance practices. This was found with the objective to promoting good corporate governance, resulting in a long-term development of Asian economies. They particularly function in 3 areas: research, advocacy and education. Advocacy and education. Next, Corporate Secretaries International Association is an CSIA is an international body set up with the objective for promoting good corporate governance practices by enhancing governance professionals. They have given 20 steps for better corporate governance. So 20 points we have to read, and for the KMPs, NEDs, directors, related to them only they have given. Next, International Integrated Reporting Council, IIRC. IIRC is an international body which is a cross section from across the world, ranging from academics to corporates, regulators, who are tasked to form a framework of reporting which allows the countries to move from narrow financial reporting to a comprehensive framework, includes both financial and non-financial. The IIRC is set up with the following vision to establish integrated reporting and integrated thinking as a mainstream business reporting practice. Vision to achieve a reporting framework which shall be able to communicate an organization's strategy of performance alongside the industry in which it operates. B. Provides a coherent, that is clear and concise framework which allows a holistic reporting, and to develop a reporting framework which is internationally agreed, resulting into more ready or easy understanding of the information presented. A framework which will reflect the relationship and interdependence of all the capitals on which an organization is dependent. C. To develop reporting framework which internationally agreed, resulting into more ready or easy understanding of the info presented. A framework which will reflect the relationship and interdependence of all the capitals on which an organization is dependent. And E. A report reflects how value is created in the medium to long term for the investors, customers and employees. And at last, new additions applicable for December 25 attempt is that is the amendments part, so you have to do it. In that, first they gave CSRD, its objectives and applicability, and in that you can do point 1, 2, 3, point 5, point 6, point 7 and point 9, point 12, 13, 14. That's enough. And in IFRS, point 2, 3, 4, enough. And we are done with chapter 1. Happy learning. Thank you.